What is up, YouTube? Welcome back to Stacks by the Numbers. Today is Friday. We're about to end out the week here, and I wanted to take a look at another brand name company that has been selling off that, in my opinion, now we can potentially begin to utilize the Buffett method to slowly accumulate shares, build a position, and catch the U-turn in that slow growth, hopefully going into like the first 1 to 2 quarters of 2024. Name of the company we're talking about: Hershey Company, ticker symbol HSY, listed here on the New York Stock Exchange. Obviously, if you're here in the States, you're very familiar with Hershey. Been around for a very long time, make chocolate, and obviously a bunch of other snacks now and whatnot. But basically, what's going on here is the stock's trading at about 182.5, and as you see, we actually hit new lows today, 182.36. Stock right now is down about $3.70, right around 2% currently. Market's kind of bouncing around. We were nice and green, now we kind of pulled back, we went red. So only time's going to tell how the week officially ends here. It's about 3 o'clock here, Eastern Standard Time, so we still have about an hour to go. But here, looking at Hershey, it's very interesting because, first of all, let's look at some of the numbers here, right? We have a market cap of about $37.33 billion. Company is paying a dividend yielding a little over 2.5% right now, where the stock is currently trading. We have a company trading roughly 20 times earnings right now, which, again, with supposedly all of these traders and investors just blindly buying these stocks and bringing these indices to, back to these 52-week highs and potentially all-time highs rolling into the new year, to have a brand name company like Hershey that has revenue and profitability increasing, trading only at 20 times earnings, in my opinion, tells me it's at a discount. This could easily get up to 25, which of course would be a 25% increase, which would be roughly a 45-point move on a $182.50 stock, which would bring us to about $225 a share. And that is kind of around a lot of the price targets of some of these institutions. We'll get to that in a second, but as we see here, the last 4 quarters, the company has been beating on the profitability side pretty healthily, as you see here. 5+% beats here, north of 10%, and almost 14% going back here, with, it looks like, the EPS kind of right now in the median range of the last couple of quarters here. So, of course, we have to wait. Those earnings coming out in roughly 48 days. But as we come down here, we can see, first of all, for last year, the company made $10.42 billion. Okay, and look at that. Look at that profit margin there, just a touch under 16%. If we look over the last several years, we can see, going back to 2018, $779 billion, $799, $815, $897 billion, and now $10.4 billion. More importantly, look at the net margin percentage, right? The profitability itself. A touch over 15%, a touch below 14.5%. Now, again, this is lockdown year. Revenue and profitability goes up to almost 15.7%. Coming out of the lockdowns, as we see, revenue up to almost $9 billion, net margin percentage almost 16.5%, and now, as of last year, 2022, net margin about 15.8%. So even going back to before pandemic, not only is the company doing more revenue, but they're actually more profitable than they were before everything got locked down, which, first of all, $10.4 billion, right, for last year. And if we come up here again, about $37.33 billion. So the company's trading like 3.3, 3.5 times annual revenue, which, of course, if we look at a lot of the other companies that are in the spotlight, that is nothing. We have a lot of companies, in my opinion, that are not as financially sound and not as fundamentally healthy as a brand name, 100-plus-year-old company like Hershey. And those stocks are trading 7, 8, 12 times annual revenue, right? So if they can do it for them, we can definitely see some growth here for Hershey. And even switching over here quarterly, we can see, yes, the revenue slightly bouncing around, as you see, 273 down to 265, yet they were more profitable, going from 14.64% net margin up to almost 15%. Then you can see just about $3 billion net margin, almost hit 20%. Then we had the slight pullback there in Q2, but I still say, in my opinion, especially dealing with this hyperinflation and everything that's taking place, 16.33% net margin percentage, definitely nothing to sneeze at. And then you move forward to the quarter after that, and you can see they broke above $3 million, and the net margin now north of 17%. So even if we bring this profit margin down a little bit, we can see that overall we have slow growth here in the profitability side, and the company seems to be also generating decent revenue that is higher than where it was. So it makes me laugh that on a day like today, the company gets downgraded here by B of A, and right, could be tested by confection inflation in 2024, says Bank of America. What are these people talking about? What are these people talking about? Isn't the market raging and hitting these highs and going to break into even newer highs now in the next couple of weeks going into 2024? Isn't that what all the traders and the people on YouTube are saying? Oh, the Fed came out, inflation is cooling, let's go, we're going to all-time high. Well, how's inflation cooling if you're telling me it's now going to affect Hershey in 2024? First of all, they've already proven in the numbers, as we just looked, that inflation, apparently any inflation that they're dealing with, is not really an issue. Because not only are they still generating their consistent and also increasing revenue, but on top of it, they have been increasing their profitability. And now all of a sudden, after the stock sold off and is approaching this purple trend line, which I'll show you in a second, that is the all-time support trend line, okay? They are beating this stock up, bringing it down to the all-time support trend line, citing that this stock should be selling off and is going to have a rough 2024 and should be hitting a new 52-week low today. And what is their reasoning? Confection inflation in 2024. Well, I thought inflation was curbed. I thought it's cooler. This is what bothers me about the nonsense economic reports that they try to push onto us, trying to, in my opinion, just blatantly fudge a lot of these numbers and a lot of this data just to have the market stay secure and potentially even climb higher. Just remember, we've been raging for about 6 straight weeks because inflation was quote-unquote cooling. Now, Hershey gets downgraded and hits a 52-week low because inflation is a factor in 2024. Make it make sense. But anyway, obviously, I don't know who works at B of A, but in my eyes, I don't know, maybe they downgraded it so one of their other buddies at another firm could take a position. But B of A Securities downgrades Hershey to neutral from buy. That's interesting. So in B of A's eyes, it's no longer a buy. Think about that. Amid limited upside potential in full year 2024, cuts price target to 200 from 250. So obviously, apparently, they had to lower their price target by roughly 20%. And again, they are citing inflation. And again, everything went up because inflation went down. But now Hershey's going down because inflation's going up, right? Just keep that in mind. Price target here at 200 still, about 10% higher than where we are now. So again, if you want to keep the stock flat or slightly red on this news, I can appreciate that, but to have it drop down to new lows even when their lowered price target is still higher than where the stock is, it definitely raises an eyebrow in my opinion. Look, Hershey facing rising cost, slowing candy, well, that's not what the numbers are showing us. I don't know. In my opinion, again, I know I'm kind of just speaking like in generalities here, and I may not be getting into too many specifics, but again, this is why I say you don't necessarily have to be a rocket scientist to understand what's going on with the markets. And again, I will say for the nth time, markets rallied like crazy almost every day for the last 6 to 7 weeks straight, because supposedly economic data came out showing us that inflation is quote-unquote cooling. But yet for this company, they're getting destroyed, right? How come we're not seeing this across the board? Only confection inflation will be affected by 2024? Like, come on, give me a break, man. Give me a break. Where are the realists? Let me talk to an analyst who's grounded here with some common sense. But anyway, 200 plus, in my opinion, is a very, very easy price target. Initially, back here, like the end of October, when I saw it down here in the low 180s, I actually mentioned that, in my opinion, I would actually step in and buy calls here down here in the low 180s. And obviously, again, the markets absolutely began raging because, again, inflation, quote unquote, cooling. So this stock, as we see, rallied all the way up and almost went back to 200 just within about 2 weeks. So I know some people in the Discord jumped in, made a couple of bucks, and then when we dropped back down and retested, I basically said the same thing. Hershey's a brand name company. Now this is an overreaction, right? Now it should go higher. And we can see that it bounced around and it tried to fight to get back above a few of these trend lines. However, it does look like, again, we may potentially formed a little bit of a descending triangle, but either way, this catalyst came out today, so Hershey takes a chunk down. But you know what I'm going to say? If I liked it a day or two ago at 185, 186, I'm going to love it at 182.60 and even 181.60 if we drop down to this trend line. Let's back out the chart. Boom! Look at that all-time chart. Unbelievable. Imagine thinking that this company is going to struggle, right? Where's the downgrade on McDonald's? Pfft, look at that. Okay. So apparently inflation is only affecting Hershey, right? Keep that in mind. All-time fib level here of 182.98, obviously key level, and the stock broke below that and is currently sitting below it. That's why I feel, in my opinion, they may actually bring it down and beat it up here and have it touch this long-term trend line again. And also, hyperinflation happened after 2020, after the lockdowns. You all know this, I'm sure, as our government just began printing trillions of dollars. And yet somehow the stock drops down and retests this all-time support trend line down here at, a 111, 109, wherever it was, and yet seemingly goes on almost a 3-year tear, hitting $276, $277. But now all of a sudden it's a piece of crap and it's dealing with inflation. You can't play both sides of the fence, right? We know what's going to happen, in my opinion anyway. I know what's going to happen. Of course, I cannot say it to you all matter-of-factly, but the fact that this massive sell-off even happened is a joke. It's a joke. And like I said, you have other companies like Tesla who has actually been missing earnings consistently, especially on the revenue side. If you go back and you check the last 3, 4, 5 quarters of Tesla, they have been missing earnings consistently. They recently got a price target downgrade. They recently recalled over 2 million vehicles. And if you look now, the stock is actually higher than where it was when they missed earnings last quarter. Make it make sense. Make it make sense. And I'm sure there's going to be one trader who's going to try to jump down my throat. Oh, interest rates, that's why EVs started climbing. Yeah, sure, okay, whatever. Just remember, the proof is in the pudding. Men lie, women lie, numbers do not lie. And in my opinion, I feel that a company like Hershey has significantly better numbers right now than a stock like Tesla. But of course, the difference is Hershey is more of a boring company, a slow and steady climber. So the average person on YouTube or the average person in their trading Discord never look at companies like this. Meanwhile, I've proven on my channel already that you can have phenomenal, stable, steady growth over the months and over the years by buying brand name stocks at discounts. So that's why I feel, again, to answer my own question, the only reason why Tesla is potentially performing better than a stock like Hershey's when it's been nothing but negative news is because of the fact that all of you guys are all consistently watching Tesla videos and people are constantly doing Tesla trading videos, and in every trading Discord every day they're telling you to buy calls on Tesla. It's going to 240, next stop 260. So that's why I truly say that when you look at these companies, you have to understand the whole broad, bigger picture as to what's going on. And listen, I love when stocks fly underneath the radar. I really do. Because then when we get to the point we should be at, that's when newer people hear about it and the FOMO comes in and that late, uneducated, extra volume starts hitting the stock. And that just helps us out more. Because we knew to buy it at a discount. We're not going to buy this when it's back up to 220, 230. We're buying it here, sub 200, sub 190. But again, it's really all about how much you want to educate yourself and how diversified you want to be. And unfortunately, all of YouTube finance and trading and all of trading discords only focus on the tech sector and just a handful of stocks in the tech sector. And it's a shame because when we look at companies like Coca-Cola Consolidated, which we spoke about recently, COKE, hit another all-time high today, north of $890 a share. Originally brought to you on this channel at $550 a share. CBOE, I reviewed down in the low 100s. That stock climbed up to north of 170, 180, hit new all-time highs as well. Pays you a dividend the whole time along the way to own it. And I can guarantee that you go to these traders, you go to these finance people on YouTube, they never heard of Coca-Cola Consolidated. They didn't even know it was a publicly traded company. The CBOE is the actual options exchange based out of Chicago that is publicly traded, that in my opinion will inevitably continue to grow higher based on options volume coming in and commissions made off of those trades. And of course, they're consistently paying you a dividend to own it. And I can almost guarantee that all of these people on YouTube and all of these people in the trading discords probably don't even know that that company exists and even trades public, where you can actually own a piece of it for your portfolio. So again, I know I went off on a little bit of a tangent, but again, the more under the radar it is, in my opinion, the more I like it. So again, this is our long-term support trend line, and that's why I'm saying, I even mentioned earlier in the Discord, maybe we can see a drop down to 180, 160. You might see a little flash crash right below this trend line here and potentially touch a fib here of about 181 and a quarter. And that's what I mean. We could potentially drop to like the high 180s here. But then in my opinion, I think it's going to spike back up. And remember as well, as I showed before, the numbers look pretty attractive. And again, I'm referring to like the steady growth over the last quarters and over the last several years, even after the lockdown and the hyperinflation. So that's why when we talk about the January effect that's going to happen in the stock market, usually every year, that is when all of these fund managers just kind of reposition their capital and take new positions. And what do they look for? They look for undervalued, fundamentally sound and proven companies that have that track record, that could potentially be trading at a discount, but more importantly, they feel will most likely have high conviction that 9, 12 months from that January start of the year, these stocks should and will be worth more. And that's why, in my opinion, something like Hershey's, absolutely perfect, especially when we talk about the January effect, right? Like I said, had a nice steady rally, got up back up to the mid 270s there. Now it just completely fell off the cliff. So they can get it from here. They can get it at a 33% discount near all-time support. They can scoop it up as a discount and they can ride the wave now throughout the next 6, 9, 12 months back to 210, 220, 230. That, in my opinion, is what's going to happen. Both fundamentally and technically. Again, we looked at a lot of stocks that I feel weren't fundamentally or even technically sound. And, they didn't break down as we thought, and they continued kind of slowly rising when I felt they shouldn't, in my opinion. So that's why, looking at something like Hershey's, I'm really not seeing a reason as to why it shouldn't. Again, if they want to bring it down and test, fine. But it really should hit that line and then begin to rally back up. And you can see, even this was Wednesday, even midday, I wasn't exactly sure if the Dow as a whole would climb. So I kind of just started mentioning some of these Dow companies in the Discord, like Verizon and Philip Morris. And looking at a stock like Hershey, you can see it immediately had some positivity come out and came up and basically retested this trend line here, but then immediately rejected and dropped down. And then, of course, we have our downgrade today, in my opinion, for absolutely no reason. So, might be rocky for the next couple of days, but again, people are forgetting that this earnings coming up, I got to switch over to the 1 year. So this earnings come up, as we see, estimates are actually a little bit lower down here at 2.7 billion. And this is the period ending December. So that's why, usually around these holiday seasons, because people were pumped about it in October. That's when people first brought it to my attention and said, oh, you think we should buy something like Hershey for Halloween? And I said, no, wait, remain patient, let it continue to sell off. And that's why, as you see here, it was actually right around Halloween when I said, okay, it sold off as expected, like now it'll get a little bit of a bump, and then that's what happened. Of course, the markets helped it out, but that's what I'm saying now. Even moving forward, right? This was the period ending September, so there's going to be the period ending December. So this is going to be all of the Halloween candy coming in and all of the Thanksgiving and Christmas gift baskets and chocolate baskets that are given out to friends and family and whatnot. So that's why, in my opinion, I am personally pretty confident that this company will bounce, get back above 200, and chances are rally into those earnings because they'll probably beat it. And again, we can look back here. This was a key level, the tail end of July, as it started to sell off, and it broke this level of about 237.5. And we can see if we connect those two tops of these candles here and come down, again, it may not be exactly accurate, but you can see here, as we go into December, January, even coming back to this trend line, you're looking at 208, 209, 210. So that's why, again, don't expect to make $1 million overnight with a lot of these situations. But if we have higher conviction, then you could potentially, if you want, take on a larger position. And of course, if you're patient and try to keep your emotions out of it, you will most likely see slow, steady, stable growth. And they're paying you a dividend to own the stock in the meantime as well. So that's why, overall, in my opinion, I do personally like Hershey. And even looking at some of the numbers here, the book value per share, again, compared with where the stock is trading, it may seem like a high multiple. However, if you look at the growth in book value over the last several quarters, I mean, it's up north of 33%, really, in about the last 12 to 18 months. I mean, it's nothing to sneeze at. Look at the book value over the years. And again, this is when 2020 hit, right? This is when hyperinflation started. And since 2020, book value for annually, we're looking, book value went from about 10 3/4. Now it's north of $16 a share. So the fact that this company is plowing through all of this BS nonsense happening in the economy and been dealing with quote-unquote confection inflation for the last 2 to 3 years, and they still increased book value by north of 60% during that time frame, for B of A to come out with this report here is a joke, in my opinion. They should be embarrassed. But again, that's just me. That's just my opinion. You know, I'm sure other people are looking at this a little bit differently. Yeah, cost of goods. I mean, honestly, it seems like it's proportioned in line, right? Cost of goods went from about $4 billion, now it's up to almost $6 billion. So you may say, wow, it's about a 50% increase. Yeah, but the revenue increased 50% as well. That's what I'm saying. So, like, they're keeping pace, right, with everything. So that's why to come out, listen, if you want to come out and say, we don't think it's going to 250, we think it's going to like 210. That's very, very different than saying flat out, oh, they're going to struggle in 2024 due to inflation. What are you talking about? Markets are rallying for 7 weeks because inflation is supposedly cooling. But now inflation is going to hit not everyone, but just the Hershey Company in 2024. That is quite a freaking prediction. So apparently we got Nostradamus over here at Bank of America making these calls. So I guess we'll see what happens. But I would... like I said, I've been making some pretty decent calls here, especially when it comes to utilizing the Buffett method. So unfortunately, even if I am incorrect in the immediate short term, I have to stick to my guns and I have to stand by my analysis here on that one. I really do. We come down here, look at this, just beating annual revenue for the last 4 years in a row, beating annual profitability for the last 4 years in a row, consistently increasing dividends for the last 5 years in a row through shutdowns and hyperinflation, right? Short-term liabilities are high, but overall assets are outweighing liabilities as they should. Debt climbing, got up to 538 and then took a little bit of a leg lower there, 512 billion in 2020. But obviously, you know, $5 billion in debt, not a huge chunk of the company itself overall, if you will. And look at the PE. Now it's down to 20. Look at that. It's the lowest it's been going back to March of 22. Price to sales, 343. Lowest it's been going back to March of 22. Same thing. Price to cash flow, lowest it's been. Price to book, now sub 10. Lowest it's been. This is why I like looking at the numbers. Return on assets, again, was higher, kind of dipped down into the low 15s. Now it's making a rebound. It's up to north of 16 and 3/4. Return on equity slowly dipped down. Return on invested capital is up almost 1% here, and we can see this is the highest it's been. Gross margin percentage, again, that's what I'm saying. They may want to beat it up in the immediate short term. Something like a gross margin percentage dropped 1.5%, but also at the same time, not only was it even higher, but of course it was even lower at some points here, 41, 42, right? So that's what I'm saying. That's why now it's back up to like 44 and a third. I mean, they seem like they're maintaining their mean average there. You understand what I'm saying? If this came out like 34 and a third, then I can understand. Hey, listen, they might have a serious problem here. We really might start selling off to new lows. They might start beating them up. Be more understandable, right? It just doesn't seem understandable to me. Same thing with the operating margin. Yeah, it bounces around. You got highs of like 25, 27, then we dip down to sub 20. 20 and a half, 21, right? And it's sitting here at 23.7. Seems like it's about median range. EBITDA, once again, earnings before interest, taxes, depreciation, amortization, sitting here north of 27%. Well, technically it went higher, right? So that's a positive. The net margin percentage we looked at before, not the highest it's been, but, compared to where it came from, it looks like they're really kicking ass and taking names here, sitting here north of 17%. So this is why I always say, like, take what the market gives you, and you don't have to buy every day, and remain patient. Try to instill that discipline in yourself. Keep a watch list of brand name companies like this. Again, this is just my opinion, the way I like to do it personally. And again, this is more for, it helps with trading, of course, if you're able to afford time on the options. But, more for shares if you're looking for a longer term hold, you're looking for like that steady, stable growth. Something like this, like a Hershey. Let them beat it up. Let it fly underneath the radar. Let it get these downgrades. Let it approach these new lows. Okay, no problem. Now the stock looks attractive. Now you step in. You buy a brand name company at a deep discount. And remember, if markets truly are going to continue to rage for the next 2 weeks, and even continue to rage throughout the entire month of January on the January effect, then obviously something like Hershey, even if it moves slowly, will of course ride that momentum wave. And that's why I'm saying conservatively 200. I mean, we got a 10% move here on our hands, in my opinion. Hit new lows as we speak. It's just laughable, really. It really is just laughable. Inventory been bouncing around. Yes, it was well above 5 and dipped below it at one point, but it was at 466. Now it went back up to 484, right? So this is why I'm saying there of course, there may be a few negatives, but I just feel like, in my opinion, the positives significantly outweigh the negatives here in this situation. Nice, healthy dividend payer. There you go. Look at that. Look at that. But for some reason, confection inflation is now going to negatively impact the company. Look at that. See, that's what I mean. They used to struggle, right? Isn't this hilarious? They used to struggle. They used to struggle. Then in 2018, it seems like they turned it around. In 2020, again, everyone got locked down. Everyone's businesses took a hit. But yet, for some reason, this company continued to climb not only on the revenue side, but on the profitability side, and has been kicking ass and taking names since 2020. So this is why, again, I also say to slowly accumulate shares and build a position. Right? Imagine you went all in yesterday at like 184, 185 just because you felt it was undervalued. Now you wake up today, you got this BS news report. Now the stock's at new lows, 182. You're instantly down. No. Decide how much you would consider overall putting in the position. Then you begin to piece your way in 10, 20% of that capital at a time. Dollar cost average down. That's what I mean. And if you bought it a couple of days ago at 188, 185. That's why I always say, if you liked it at 188 and you like it at 185, then you should love it down here at 182. And again, I know it's very emotional and we don't like to see the value of our positions go down. But if we look at a lot of other stocks, look at SoundHound. I just did a video on that. SoundHound, remember, they dipped it down to like 1.5 when it was holding 2. And everyone's like, what's going on? Should we get out? Are they going to beat it up? And then what happened? They brought it right back up to 230, retesting the trend line at 240. And what's everyone say? I should have bought it when they sold it off. Yeah, but you didn't because you were emotional. You completely disregarded the overall analysis and the long-term vision of what we brought to the table. And you just said, I own it at 2. It's at 1.5. Oh, no, this isn't good. This isn't good. Instead of taking what the market gives you and taking advantage of the situation. Because if you liked it at 2, you should love it at 1.5. Same thing with STEM, another perfect example. Started selling off. We thought it was going to hold 3, like no problem. Then it breaks down, 285, 2 3/4, 260, new lows. What's going on with STEM? What, should I sell? What's going on? No! We looked at the whole situation, we understand the long-term vision, and if your cost basis is 385 and now it's at 265, you should be salivating at the mouth trying to accumulate every share that you can. Of course, with holding that rule, in my opinion, of not investing 10% or more into one single position, right? We don't want to overexpose ourselves. Nothing is ever guaranteed in the market. So I do feel, I also agree with that 10% rule. If you have $100,000 in an account, you should not have 50,000 in, QQQ calls or something. Even if you're right. Because remember, if at any moment something is said, markets begin dropping, all of a sudden the NASDAQ starts selling off, you will instantly take a 5-figure loss. And that's why I always say these sayings. Again, 10% of your portfolio in one position. Aim small, miss small. One of my favorite ones. Aim small, miss small. If you're going to do speculative options trading, you absolutely should be aiming small. Because if you're wrong, you only lose what you put up. And if you're right, the situation was so speculative and risky that you're going to see 1, 2, 500% return. So that's why even rolling the dice with some of these crazy spec plays, if you aim small, then hopefully, if you know what you're doing, the wins will outweigh the losses, even when you take them. But again, looking at this, I don't know. The company seems like it's gotten stronger in the last couple of years. And again, apparently they're expecting inflation to only hit the Hershey Company, which, in my opinion, is just straight nonsense. But again, could potentially sell off here. But I do have a feeling that, again, we've been in this downward channel since like May. So I have a feeling that we do break out and climb up. Remember, same thing happened with Hershey, right? They beat it up. Campbell's, excuse me. Same thing happened with Campbell's. They beat it up. I think I brought it to you guys at like 42 maybe, and they continued to beat it up 41, 40, right? And everyone might have been sitting there like, I guess this guy doesn't know what he's talking about. I guess the timing was off. No, if I like it at 42 and then the market gives it to me at 40, I'm just going to add more shares and average down. And again, I see that it's slightly red today, but of course the other day it was north of 45, I think approaching 46. So that's what I mean. That's why even with some of the calls I make, I could initially be incorrect, but this is why the track record speaks for itself. And if you have that 8 out of 10, 9 out of 10 success rate, you have to trust the process. I'm going to switch over to stock charts very quickly because this video is way longer than I wanted it to be already, because that's what I do. I ramble. So here we're looking at stock charts. We're looking at the daily. Let's update it. As we see the RSI sitting here a touch over 38. Approaching that 30 benchmark, but again, in my opinion, with this recent BS negative catalyst, again, we could potentially have maybe another day or two of red if Wall Street and traders want to try to jump in and short it to beat it up for a quick scalp. But in my opinion, I am expecting a bounce personally soon. The MACD is high and looks like it's slowly pulling back, but I think it's going to be okay. The bottom Bollinger Band here, 182.61. We can see the stock right now about 182.25. So we've broken that bottom Bollinger Band and potentially forming a bear hammer, which could bring us a little bit lower. But again, I like it overall. I like it overall. We'll switch over here weekly. Yeah, sometimes it's just that simple. If you like it and it looks good, you like it. Looking at something like this, does scare me a little bit, because I will show you here that we had this big sell-off, but then it bounced nicely off of this 200-day moving average on the weekly, and now you can see now today it has broken that 200-day moving average. So this is why I'm saying one of two things are going to happen. Either they're going to keep beating it up for $1 or $2 before they have it bounce and reclaim a level like a 200-day moving average, or tomorrow it can just immediately pop back up to like 184.5 and get right back to that moving average. But again, overall, I may be speaking generally here, but I personally do like a company like Hershey, especially around this time of the year. MACD looks like it was about to cross to the upside, and then, of course, the stock has sold off for the last several weeks. So RSI now sitting sub 30, and again, we can see it was well below 30, but it does have that bounce, and it also has the ability to have an RSI well over 80 for several weeks. So, we could use the RSI as a potential buying indicator, but not really. Let's look at the pivot points real quick. I'll let you guys go. Pivot points here on the weekly, 194.63. We can see we had a lot of action there at around that level, and of course it just happened to reject and drop back down. This 162.25, that would be an extreme overreaction in my opinion. And let's just check the daily very quickly. Boom, we're right here, basically at support, 181.84. So we're about a quarter above that support level. And again, something like this, like a flash crash down to 175, I just think is ridiculous. But I will say again, like I always say, if I liked it at 182, I'm going to love it at 175. And also the Bollinger Bands were showing us a price like that as well on the weekly, showing us a bottom Bollinger Band here of 173.24. That just seems like an overreaction, right? So on these big drops, the Bollinger Bands balloon and trumpet out, as I said. So the bottom Bollinger Band kept dropping and sliding with the stock, kind of maintaining that pattern. And then as you see, the top Bollinger Band comes down and kind of tightens up. So now, this is what I'm saying, even going into the new year with a bullish market, maintaining momentum with the January effect and new volume coming in, we can see the top Bollinger Band kind of diverging here with the 50-day moving average of 226.5 roughly. And that's why, again, I'm saying, I personally, in my opinion, truly believe that this company can easily regain the 200 plus level and even potentially get back to 2.25. The B of A article today, I don't know. I kind of have to, in my opinion, say that kind of one hand may potentially be washing the other over there. But again, I don't want to go down that twisting, winding road. I'd rather look at the numbers, look at the brand name company, look at where they came from. Right? I mean, look at this. They brought the stock down all the way to where it was before 2022 started. And then look at what the stock did for 18 straight months. You know what I'm saying? So that's what I mean. What goes up must come down. Let them beat it up. Let's start accumulating shares here at a discounted, lower, attractive price and just give it some time. And I think, in my opinion, everything will be all right. And I'm going to end it there, because I talk too much. So once again, this is Stocks by the Numbers. I want to thank you guys for stopping by. If you have any questions, comments, or concerns, drop it down in the comments section. I'm usually very quick to reply. Thumbs up algorithm helps me get more eyes on the channel. And of course, subscribe to the channel. That is our handshake agreement. That is how you help me help you. But more importantly, moving forward, like I always say, I understand that markets are very rocky. We're volatile. We're up one minute. We're down the next minute. I understand it's very uncertain, emotional, very stressful. I want to wish all of you success. I hope everyone makes a couple of dollars. Thank you for stopping by. Enjoy your weekend.